Welcome to Sovereign Finance, the show that connects the dots between personal finance, global finance trends, and deep human history. Tune in every week to demystify the money puzzle and protect your interests in a turbulent world. Welcome to Sovereign Finance. I'm your host, Rob Drummond, here with Derek Dearden. How are you, Derek?
Great, thanks, Rob. And you?
Yeah, not too bad, thanks. So on last week's call, we did an introduction to microfinances, if you like, for small businesses and small business owners. And we kind of left off the chat by saying, well, as pensions are one of the main vehicles for building your wealth over your lifetime, it's probably worth you knowing how your pension is being invested, and maybe having a bit more control over that. And I wondered if we could pick up on that thread.
Right. Okay, so once again, usual disclaimers. I'm not giving financial advice here, but what I am doing is giving you a bit of educational background into the mechanisms so that when you're discussing things with a so-called financial advisor, that you can evaluate what he's saying and you can see what scope there is for making your own decisions. The arrangements for arriving at a pension are just broadly exactly the same as for any other kind of long-term wealth building. Essentially, you're putting money into something which is going to yield a return, and you're going to accumulate those returns into the fund so that it grows exponentially, if all goes well, over time, and ends you up with a capital sum. And then you move from the accumulation phase into the, if you like, distribution phase, where you use the income from that to provide you with the money that you need or want for the lifestyle that you want, without having to actively earn it any longer. And I think a lot of people, they just take this at face value and assume that there's some kind of magic. But let's have a look at what's actually going on and how that wealth is generated. If you go back to what we were talking about in the last call, which is if you're running a small business or even if you're running your own household, there's there are certain processes that are going on whereby wealth is being created. If you took the example of, for example, a carpenter, he'd be taking raw materials in the form of planks of wood. He'd be working on them, turning them into chairs and tables and cupboards and so forth, adding value with his activity, his expertise, and providing something which is of higher value that can then be sold, which covers the outgoings of the business and provides him with an income. And actually, I'd just like to digress for a moment, staying with that small example. I think a lot of a lot of small entrepreneurs don't ever pause to reflect the different streams of income they're getting from their business. As far as they're concerned, it's just like a wage in a way. Now, you have several hats on if you're running particularly a one-man business or any kind of small business. If you're running a one-person business, you've got several roles. One is that you're a worker in that business. One is that you're a manager in that business. One of them is that you're a director of that business, whether or not that it's set up as a limited company and you've got a formal title as a director. And the fourth one is that you're an owner of a business. And if you look at a larger enterprise, those are distinctly separate individuals. So let's look at the roles. As a worker, for instance, in the example of the cabinet maker, you're actually doing the work, and there should be a going rate for that as work. And the best way of costing that is at an arm's length basis of what you might expect if you were an employee of somebody else doing that work, or what you conversely might expect to pay somebody else that you hire to extend the size and the scale of your business for doing that. So the second role is as a manager, and the manager decides what to be done, decides what the priorities are, decides how the time is to be spent on the various tasks that are involved with running the business, as well as the actual activity of creating the output of the business is concerned. There's going to be a certain amount of administration, there's going to be paperwork, there's going to be billing customers, there's going to be paying suppliers, there's going to be dealing with the tax man. And there's going to be deciding what to invest in, whether to buy a new circular saw or a new planer or a new computer, or replace some tools that are wearing out and so on. Those are all management type decisions. And you'd expect the role of a manager to be paid more highly than a worker. And then a director, we normally think of company directors these days as being involved with the running of the business. And some are, if you like, directors and managers, or directors and executives. But historically, the two roles are entirely distinct. The directors are to, if you like, provide long-term strategy and direction for the business, and to supervise the managers to see that they're acting in harmony with the interests of the owners of the business. And then finally, as a one-man band, you would be the owner of that business. And the owners of the business would be like the shareholders. And if you go back to the concept of a joint stock company as it was originally conceived, pretty well in the 19th century, maybe it goes back further than that, but it obviously came to the fore with the Industrial Revolution, when enterprises became a lot larger and more complex, and require more capital to set them up than was likely to be possible for an individual. So people would group together, they'd apply capital. Suppose they were wanting to build a steelworks, 100 or 1,000 people would come, they'd all put a certain amount of capital in, they'd get shares in the business, and the money that they put in would be used to build the blast furnaces and the rolling mills, and then get the initial stock of iron ore in, and set up all of the structures for operating the mill and for selling the steel that came out of it. And then once it was running, they would receive a regular income from that. So in the same way, if you're a small operation like that carpenter, you would expect that as the owner of a business, you would get some remuneration once it's running at a profit, over and above what you're getting as a wage earner, what you're earning as a manager of that business, and what you would expect as fees as a director for the decisions to chart the operation. And if it's a successful business, there would be coverage of those at a going rate and a bit more. And then that bit more, you could do one of two things. You could either reinvest in expanding the capabilities of the business, or you could draw some of it, if you like, as a dividend. Is that clear? Is there anything that you want to clarify with what I've said so far?
No, I don't think. I think we're all good. That makes sense. Even for me, just relating that to me and my business. Obviously, I play all of those roles at the moment.
Yeah.
My management responsibilities largely happen over coffee in the morning, but
yeah,
they're still there.
Right. So the same applies to a large operation. The other thing is that I mentioned with capital, assuming that you've got a business, it is a going concern, the business owns all the capital that it has, the capital in terms of the tangible assets that are necessary to run the business, the woodworking machinery, the tools, the stock, in that particular example. Now, if you are running at a profit, as I say, there are basically two things you can do with it. You can either use that profit to expand the capabilities of the business, buy more tools, perhaps even employ another worker, or you could use that and take it as a bonus and use it for your annual holiday, or transfer it into your own personal investment elsewhere. If you do need to, if you do need more capital, there are two ways broadly that it can be sourced. One of them is from the existing owners of the business, the existing shareholders who it's multiple ownership, and the other is by a loan. If it's by means of a loan, there's going to be a fixed interest charge on that loan and it's also probably going to be paid off over time. So if we now look at the situation where you're trying to build up a pension pot or any other kind of long-term asset over the years to put yourself in a more comfortable position, then what you're effectively doing, and it's usually through an intermediary like your pension plan, is you're investing in other businesses. And you can invest in one or two ways. One of them is by owning the shares in the company, and another one is by buying bonds, either bonds in commercial operations or bonds issued by the government. The advantage of owning bonds is that there is a predictable income from it, so they're regarded as a safe investment. Of course, that is assuming various things. It's assuming that if it's a government, that the government isn't going to default on it.
Can we just define what a bond is?
A bond is simply a note indicating that you have made a loan to that company, and the company is agreeing to either repay the loan at some specified future date. Certainly with a commercial bond, that would be the case, and to pay interest at a certain rate. And the same applies with government bonds. In the past, the British government was in such a well-respected position that it could issue bonds which were undated. But the thought being that there would always be a market for somebody else to take your government bonds off you if you decided you didn't want them any longer. And also the other assumption, as I think we've touched on in previous points, is that the value of the pound sterling was going to be stable, which of course it was for about 300 years and has definitely not been for the last 110. Those are the investments, and it's not the path of least resistance, and what's regarded as the safest thing is to simply buy a pension plan of some financial organisation. Usually they're the same as the institutions that issue life insurance and other forms of insurance. But
if you're an employee as well, you might be also enrolled in one of these things. Even if you're an employee in your own company, if you're on payroll.
If you're in a company, there's very likely to be a company pension scheme, and effectively the company is going to do the same thing as you would if you were taking your own thing, which is to take out the plan on your behalf, pay either from the company itself or from deductions from your salary into that scheme. So the pension plan trustees will decide what mix of investments to put that in, and they will be large corporations that the plan either holds shareholdings of or company bonds or government bonds, and these will yield an income. If it's a bond, they'll be receiving interest, and the arrangement will be that that interest will be reinvested in more units in the fund, and in that way, it can grow exponentially. If it's in company shares, it's not quite so well defined how you're getting the benefit. A lot of company shares have uh, an annual dividend paid, and that's much the same as receiving an interest payment. And sometimes, as I indicated in the example of a small business, the company might decide, rather than issuing a dividend, to plough that back into expanding the capability of the company.
Startup companies do that quite aggressively sometimes now as well.
Yeah. I mean, the classic examples are small, rapidly growing high-tech companies. If you're a well-established manufacturer of soap powder, for instance, you probably haven't got a lot of scope for expanding the operation once it's been there for many years. And so you'd expect the profits to be distributed to the company owners, the shareholders. If it's something like Microsoft or Apple in the early days, they would obviously have far more benefit to be gained by reinvesting in expanding the operation than by giving it out. The shareholders would own a share of an expanding business with expanding earnings, which would thereby be worth more, and they'd be getting the results in that way. Of course, if a business decides to, let's take the example of a retailer. Now, the retailer might typically own their premises. If you go back 50 years or so, that was fairly normal. These days, it's far more normal for the retailer not to own their premises, but to rent them from a property company. And in fact, there were quite a lot of people quite a lot of examples of chains of traditional, conservatively managed retailers being bought up by larger enterprises. And what the enterprises would tend to do, this is one of the techniques of so-called private equity investment funds. They would buy up say somebody with a small chain of shops that they owned all the premises of. They then do what was called a sale and leaseback agreement, whereby they would sell the property to a property company or an insurance company as a long-term investment, with a deal that they could lease it back from them at a specified rent. So they'd get an immediate capital boost, which they could either extract for themselves or use to subsidize the operation of the business or to expand the operation of the business and have a predictable outcome.
A lot of football clubs did that as well. It used to be very common for football clubs to own their ground. Some of them still do, but quite a lot of them now rent it. Obviously, it releases quite a lot of cash in one go.
Yes.
To not own it.
Particularly if, like in Southampton, they sold the ground that they had the football club on to build a lot of houses and flats on, and built a brand new stadium, which presumably was funded by a property company and leased to the club on a greenfield site or a disused industrial site out of town. Okay, so essentially that is the mechanics of it. Of course, if you go through a pension fund provider, the people who are operating the pension fund will be extracting something from themselves. So that's going to reduce the amount which is going to accumulate. And I'll just mention before we leave this topic that it is entirely possible to do things in what's called a self-invested pension plan, whereby you take the decisions as to what to invest in. And so that would involve, if you're going to decide what mix of investments you're going to have, it's going to be necessary to look at the prospects for the company, and it's going to be necessary for you to be able to read their balance sheet and their profit and loss account and evaluate whether you think this is a promising looking investment or not. And I think the outline that we gave in the last talk gives you the beginning of the capacity to do that. Of course, there are technicalities. You'd need to consult a professional in how to set it up. And you'd also need to have a sound assessment as to whether that professional is really acting in your interests and to what extent they're looking to their own rewards from the advice they're giving you.
Is there a point at which it's like more worthwhile doing that? Like if you've got a larger income, let's say.
Yeah, I mean, obviously, this is not relevant until you've got a significant income which is stable and reliable and is covering all your needs and is generating a surplus.
Because there's a bit of an entry requirement of knowing what you need to know.
Yeah, yeah.
Which perhaps you're arguing is not rocket science. It's not impossible, like it is doable, but
Yeah,
there's a certain
this
amount
is
of
my
work
main
involved.
point. I'm not giving you the details, but what I'm giving you is a big picture and seeing how that relates that process which is going on behind the scenes and how and what is feasible in terms of the rate of return, the overheads and taxations of it, and how the arithmetic would work out on those assumptions if it's reinvested over various periods of time.
I know some people who used to invest their pension in commercial property projects, that being one of the allowable investments from within your pension.
Yeah, yeah.
But again, it required some knowledge about commercial property and what to invest in. And, it's not something that I felt like I would want to just wander into, but I was aware that people were doing it. And these were people, just regular people, I guess,
Yeah. Well, for instance, one thing that a number of sort of medium-sized businesses do, they're going to need some kind of premises, whether it's a showroom or a shop or a factory or an office block or whatever. And I know people who have been running reasonable sized businesses, 20 people or so. They needed office and showroom premises, and so they set up a self-invested pension plan. They invested their pension plan into office premises, and then as their business paid the rent to the pension plan for the use of the space. And so from the business point of view, it's, let's say, exactly the same arrangement as it would be if they were for anybody else. But for the owners of the business, they were effectively paying themselves what would otherwise be an overhead business expense because it was going into accumulating their own pension plan. So that's definitely worth thinking of if you're in that kind of situation.
How much work and attention might it be to kind of manage these things? Like, is it the kind of thing you just check in on every few months, or like, I guess it depends what it's invested in, really, doesn't it?
It's definitely worth knowing what the value of your fund is at any time. I think they all send you a statement once a year, and once again, a lot of people go, "Well, what's this? I don't understand it." It would definitely serve us to take seriously looking at that. And of course, the horrifying thing with most plans is that I don't know whether this is still the case, but it certainly has been in the past. That there's a so-called initial management fee and an ongoing management fee. The ongoing management fee is some percentage of the funds that are under the management. The initial one was typically the first year's payments, and the first year's payments were taken as that management fee, which was typically the commission paid to the so-called advisor who advised you to take out the plan. So at the end of the year, you've been paying in for a year, and your first statement would, if you looked at it closely enough, would indicate that you've got nothing.
A big fat zero.
Yeah.
I feel like all of this is kind of predicated on a kind of model where you work until a certain point, and then you retire, and then you don't work.
Yeah.
And we're trying to figure out, well, how much do we need to have to hand at that point that's going to support your lifestyle? So there's a bit of guesswork. I was talking with a guy recently who reckoned that in his world, some people actually retire too much or retire too late, or spend too long working, don't do the trips they want early enough.
Yeah.
That's maybe something else to consider.
Well, at any given time, you've got to look at what you require in the way of an income to lead the life that you want to live. If it's in a pension plan, there are various regulations about how soon you can take it. You have to reach a certain age, and when you do take it, whether you take, usually the regulations allow you to take to up to 25% as a lump sum and leave the rest in to generate an income. And I think I mentioned before that with a pension plan, you then have to buy an annuity with it, which is like a life insurance policy in reverse, whereby you give the fund manager a lump sum, which is what you've accumulated over the accumulation period. You give them a lump sum, and in return you get an income. And of course, because prevailing interest rates in the market have been so low recently, the annuities are far less than was imagined 30 or 40 or 50 years ago when you embarked on the plan, which is why a lot of people's pensions have been very disappointing. The thing is, with annuities, it's a pretty good deal for the life insurance company that is providing them, in that when you do die, they get the entire capital that you bought the annuity with. If, on the other hand, you've not bought an annuity, which is not an option if it's a pension plan that's had the advantages of the taxation advantages of being in a plan, although those themselves are not as great as they have been historically, ever since Gordon Brown reduced the taxation relief on pension contributions. But that requires you to get an annuity. But assuming that you've accumulated the money and it's not constrained by those tax regulations, you could just buy relatively safe investments, so-called safe, such as government bonds, live on the interest payments that you receive from those over the course of the rest of your life, and then when that does finally come to an end, that capital would be intact as part of the estate to pass on to your heirs. Annuity rates, typically they're a bit higher than the safe investment because that allows for the certainty that they will carry on indefinitely if you live longer than you're expected to live. And that's what the insurance company calculations are based on. Some people live less long, some people live more long. And statistically, if you've got a large enough sample, that can be fairly predictable. I think that's probably about enough for one session. What do you think?
Yeah, I think so. My only other thought was that when we talk about pensions and think about pensions, like it automatically, I think it's simpler for people who are just salaried for all or the vast majority of their career.
Yeah.
I think maybe there's a bit more ownership that needs to be taken control of when you are the small business owner. Maybe your income does peak and trough, and when it does peak, you need to decide, like, well, what you're going to do with the excess.
Yeah, exactly.
Yeah, cool. Well, we'll leave this one there, and yeah, thanks for everyone listening, and we'll speak next week. Thanks for listening to this episode of Sovereign Finance. For more episodes, transcripts, in-depth articles and the community, please take a minute now to subscribe free at sovereignfinance.substack.com. See you next time.